I can see that European leaders have no interest for a peace deal, because a peace deal would mean that the focus of the European people will once again be on domestic issues in Europe. I look at financial market and the economy through the lens of the business cycle. So, rather than looking at official government data, in fact, I look at market data, which are much more reliable. A boom into a bust. So that's why I think that the US economy is slowly moving into this inflationary bust or stagflation. This means for investors that what worked in 2024 is unlikely to work in 2025.
Welcome to Discourse with Christian. I'm your host, Christian White, and today's guest is Laurent Lequeu, who is an independent financial consultant and writer of the Macro Butler on Substack. He's a multi-asset strategist with a track record managing institutional and high net worth portfolios. Laurent, thanks so much for being on the show today.
Thanks for having me on your show, Christian.
Would love to start off asking you, what's your current take on the global economy and financial markets?
Well, I look at financial market and the economy through the lens of the business cycle. So, rather than looking at official government data, in fact, I look at market data, which are much more reliable than government data to assess the state of the business cycle. So, basically, you can monitor the state of the business cycle through three market ratio. So, one is S&P to oil ratio. The second one is the gold to bond ratio, and finally the S&P to gold ratio. So if we look as of today, mid-March 2025, it tells us that the US economy is still in an inflationary boom, but it is trending into an upcoming inflationary bust. So if I can unpack this in a few words, I would say that if we look at the first ratio, the S&P to oil ratio, it's still well above its 7-year moving average, meaning that the US economy is still in a boom. But we have seen some weakness in this ratio, and some reversal has already started to happen. So, this means that the US economy is likely to trend into a bust probably by the second half of the year, depending how much tariff and how much trade war we will see in the coming months. In terms of the gold to bond ratio, it has been well above the 7-year moving average since the start of this decade. So whatever government or central bankers tell the people, in fact, the US economy has been in an inflationary mode since then. So this shows us that I would say we are in an inflationary boom. The third indicator, and this is the most interesting indicator because usually it gives kind of a leading indication of what's coming up, is the S&P to gold ratio. And in fact, interestingly, this S&P to gold ratio break below the 7-year moving average on the very first day of the 47 US president inauguration. And usually this is kind of a 6 to 9 months leading indicator for the US economy to move from a boom into a bust. So that's why I think that the US economy is slowly moving into this inflationary bust or stagflation. This means for investors that what worked in 2024 is unlikely to work in 2025.
And as it relates to tariffs, for those in the audience who are not familiar with your stance on tariffs, what's your take on them?
Well, in fact, I'm going to write one special newsletter this weekend on tariff. At the end of the day, tariffs are stagflationary. Someone has to fit the bill of tariff. So if it's not the companies, it's the consumer. So the problem with tariff is that tariff introduce a lot of uncertainty for business owners and for consumer, meaning that, as you can see in the latest retail sales or in the latest economic data published by the government over the past few weeks, in fact, tariff push consumption downward and pressure consumer to be very cautious because there's a lot of uncertainty. And if you look back at history of the 1930s, in fact, tariff were kind of a trigger for the Great Depression to happen. So I don't say that we are moving into a Great Depression, but I would think that the tariff uncertainty will lead to an economic slowdown, which will push the US economy from the current boom into a bust.
And I know as it relates to, you know, speculations and so on and so forth, and kind of segueing to, another thing that I'd like to inquire about is your 2025 crystal ball, your 10 bold predictions not to ignore that you put on X, and would love to have you unpack and share with the audience why you hold those opinions, and would love to start off asking, the first one that you have, which is the Fed will resume rate hikes before December 31st, 2025.
Well, I mean, coming back to the fact that the U.S. economy is still in an inflationary environment, the Fed should not have cut interest rates last year. And in fact, if you look in the past and the 1970s, when the US economy moved into a stagflation, usually the Fed has to raise rates. So I guess that because the US economy seems to move to this stagflation environment, by the second half of the year, or most probably by the end of the third quarter or early fourth quarter, the Fed, to keep some credibility, will have to raise rates. So, I mean, this will not solve the problem of the US economy because this stagflation is mostly due to tariff, it's mostly due to shortages. So, raising rates will not solve the inflation problem. But it's a matter of credibility in a world where government institution credibility is weakening dramatically.
I see. And then as it relates to the Dow will outperform the Nasdaq, how about that one?
But again, I think that if I'm right that the U.S. moved from an inflationary boom into an inflationary bust, historically, you have seen the performance of the Dow versus the Nasdaq. This also comes with another prediction: is that given that the situation outside the U.S., especially in Europe, will worsen much more than in the U.S., you will have a lot of capital inflows from overseas into the US, and investors, especially foreign investors, they look for the Dow stocks rather than the Nasdaq stocks because this is the kind of stock that they feel comfortable to own, especially for institutional investors. So this prediction, in fact, if you look since the start of the year, the Dow is leading. It has been much more resilient on the downside than the Nasdaq, and I expect that when we see a rebound in equity market by the start of the second quarter, in fact, the Dow will once again lead equity market on the upside.
I see. And then I recall you mentioning, before we went live, how over in Asia, and for the audience who aren't aware, Laurent is in Singapore. Uh, Laurent, you had mentioned about how people look at the world and have a different perspective than, of course, those in Europe and then those in the States. As it relates to the last question and such, how much of a divergence do you see in terms of where investment is going, where capital is going amongst your peers and amongst those in Asia versus perhaps Europe or other parts of the West?
Well, I think that the world is increasingly polarized. Uh, investors, especially in Asia, are increasingly worried about weaponization of assets, especially of what happened after 2022 to Russian assets that have been weaponized by Western government and Western institutions. So, looking at this for Asian investor, sure they will look. They still see the U.S. As a safe haven in these troubled times. But if I take in particular a Chinese investor, they are much more likely to keep investing domestically rather than investing in the US because in an environment where there is tariff, when I mean you cannot investor are it's difficult for investor to trust the disruptor in chief at the White House. To be honest, I think that some investor from countries like China will keep their asset domestically rather than investing in US equities. I mean, there's also one reason that you have seen a sharp increase in the gold price. I mean, the gold price has been driven by investment from a central bank, especially in Asia, especially in China. And I think this trend will continue because I don't think that these investors will get a better comfort with the new U.S. administration versus the previous administration. So outside China, I would think that countries like India, investors are much more keen to invest overseas. I mean, the rupee has been declining very sharply against the US dollar over the years. So investing in US dollar assets and US equities remain kind of a good edge for them against this declining in their own currency.
I see. And then I see for as it relates to the U.S. energy, excuse me, you put forth the U.S. energy sector will outperform the Magnificent Seven. Can you share that
Yeah, I
and
think at the
unpack?
time, at the end of last year, it was quite a contrarian call. But here again, I think that if this environment of the inflationary bust materialize, I mean, investor will look for sectors that have historically performed well during stagflation, and you go back to sectors that are all related to physical asset or real asset, meaning that the oil and gas sector, which is unloved, has a lot of potential to outperform. I know that the pushback I had from my clients on this at the time is that drill baby drill is not very positive for oil and gas sector. I kind of take the opposite view. I think that drill baby drill first is easing regulation for oil and gas US companies. And I think that in fact the US oil and gas sector is now very profitable, even at 65 or $70 per barrel WTI. So I feel that this great rotation from Nasdaq into Dow Jones will also materialize by a great rotation from the Magnificent Seven into the oil and gas sector. I also think that other sector in the cyclical sectors will do well, like materials or even industrials. I think at some point in time, this tariff will boost capex into the US. So all the companies, I mean, these are not investment recommendation, but like the Caterpillar, the Johnson Control of this world, will have a bright future in this rising capex in the US.
I see. And then as it relates to Trump's administration thus far, obviously we're approaching nearing the end more or less, or in March. What's kind of your thought so far as it relates to kind of what he's doing? I know you kind of touched on your take on tariffs, but anything you want to share as it relates to that?
Well, I think there are very few surprises. In fact, I mean, as I said, he's the disruptor in chief, meaning that he can change his mind quite quickly. Everything is about trying to strike deals. But I think that what he forgot, or what people forgot, is that to strike a deal, you need to be two, meaning that you need to find a partner keen to strike the deal. And I guess that, as I said, especially in the global south, a lot of people are not in such a mood to strike deals anymore with the US, because the world has changed since the first presidency of Trump. The world has been increasingly much more polarized. In fact, Asian countries have increasingly trade between themselves. So Asian countries, or the global South countries, are less and less reliant on the US as a major trade partner. So, I mean, striking a deal with China or with other countries in emerging markets will be much more difficult. I think that Trump has a much higher probability to strike deals with Canada and Mexico, because Canada and Mexico don't have the luxury that a lot of emerging market countries have, because they are still very reliant on the US. In terms of the economic policy, I think he understood that to please the MAGA crowd, he needs to bring down the long dated yields. That's why Besant and his team are focusing on the US 10-year yield and not on the stock market anymore. This is no surprise to me, but unfortunately, I think that since inflation restart, this mission of pushing down the long dated yields will be very difficult to achieve over the long term. So I think that we have seen a pullback in 10-year yield and long dated yield over the past few days, but this is unlikely to last since we have a reflation coming ahead of us. In terms of the geopolitics, I was positively surprised of his action, I would say, and pressure on European countries. He's clearly not for war. He's clearly trying to look for a solution in the Ukraine-Russian conflict. And I think more importantly, he understood that the bigger risk for the US is the alliance between Russia, China, and India. So, in fact, trying to strike a deal with Russia and trying to bring back Russia into the Western world is part of his view that he needs to break the alliance between Russia, China, and India, which is, to be honest, potentially the next center of the world, because it combines access to cheap commodities with state of the art manufacturing capabilities and a strong consumption in India. So I guess that he understood this. I'm unfortunately not very convinced that he will achieve his goal in Russia, because I think that Russia is much more demanding in terms of the condition for a peace deal than it was in 2014.
And as it relates to Russia, if you could you share, I mean, if you care to share, kind of what should happen, with the whole Ukraine, Russia conflict going on, kind of where given your experiences and such, and take what would be the best course of action. Obviously, you got Macron and other European leaders holding one position, and you've got Trump's administration taking another. If you care to provide any commentary on that.
Well, I'm not a geopolitical expert per se, but I would think that from my background, coming from Europe, living in Asia, I can see that European leaders have no interest for a peace deal, because a peace deal would mean that the focus of the European people will once again be on domestic issues in Europe. And to be honest, neither Macron nor any European leaders have anything to offer to their citizens. In fact, if you look at what Macron has done, or what even Steimer has done since he has been elected, or what the new German prime minister offers to his citizen. I mean, there's nothing exciting for the European people to support their political leader. So, unfortunately, my opinion is that the European leaders will want to keep the war going because it's a way for them to stay in power and to not being accountable of what they have done domestically for their people.
So do you see it, I guess, prolonging? You see the can being kicked down the road, so to speak, in terms of trying to settle it. This will just be prolonged more and more through the
Well,
year.
unfortunately, I think so. I even think that at some point we could see an extension of the conflict to new countries. I mean, Poland is the prime candidate to enter this conflict. It's unfortunate. Everyone should wish for a peace agreement and a peaceful settlement of this issue. But as I said, even if I take the example of Poland, there's an upcoming presidential election in May, and I don't see any of the candidate looking to find a compromise or to find a peaceful solution to the issue between Ukraine and Russia. I mean, if you look what's happening in Romania, it's quite interesting because all the candidates who are promoting peace and who are promoting to restore economic ties with Russia have been removed from the presidential election. So I think that this shows clearly that in Europe, unfortunately, those in power are not looking for peace. And here again, if I take a step back, I look at what is in the cards in Germany. I mean, the new prime minister just want to increase debt borrowing, to increase defense spending. I don't think that building tanks and weapons have ever contributed to a prosperous future for a country. So I feel that, as I said, unfortunately, I think that European leaders are not interested in peace, and that's why this put kind of President Trump in a difficult situation, right? Because historically there have been very strong ties between Europe and the US. But it seems that we could be at a point of rupture on that matter.
And what might investors expect if hostilities can continue throughout the remainder of 2025, and or if we see a peace? How do you see that impacting financial markets?
Well, clearly that was one of my also prediction for 2025 is that there are increasing risk of capital control in Europe, in the Eurozone and the UK. And this will mostly likely happen if the war extends or is getting worse over the next few months. You, I mean, investor must remember that Europe is on the edge of a sovereign debt crisis. I mean, France has not have a functioning government for almost a year now. They also, in fact, the election was kind of confiscated because the government that were formed and then collapsed, and then a new government was formed and is on the verge of collapsing again. Never really took into account what the people wanted from the ballot box. So I think that in the case of the extension of the conflict, I think that we could see the capital controls implemented in Europe, and that's why I mean nobody should own any asset in Europe, and nobody should custodize any assets with European banks in Europe, including UK and Switzerland. And then if peace happen, I mean I would put a low probability on that scenario. But if peace happen, I would say this would mean that Russia and Europe are able to be trading partners again. This would be very positive for German manufacturing because this would mean that German manufacturing get once again access to cheap natural gas from Russia. But this is, to be honest, a very low probability event, according to me.
And I know we're obviously covering, what's going on in Europe, and I know one of the things you also brought up as part of a prediction is a new proxy war between NATO and the global South erupting on the Korean Peninsula. Can you peel that onion back for us?
Yes, I think this is kind of related of what happened also between Russia and Ukraine. So you may remember that North Korea has offered some help to Russia in the Russian-Ukrainian conflict, and I guess that the NATO members are always trying to extend their power everywhere. So you may know or not, but there's this AUKUS alliance, which is kind of a soft proxy of NATO here in Asia between Australia, South Korea, and the US. uh, I guess that why I think that NATO will try to start another proxy war in the Korean Peninsula is that North Korea has been a viable country only because it get the help of Russia and China. And so, if we see increasing polarization and increasing geopolitical tension between the West and the global South or the East, in fact, starting a war in Korea could be a way to open a new point of tension with Russia and even China at some point. I don't really believe in the story of China invading Taiwan because there's no direct need for China to invade Taiwan. This has been on the US media for a long, long time. But the reality, in fact, is that Chinese companies are going to Taiwan and are kind of draining the brains out of Taiwan into mainland China by offering good salary and good work package to this Taiwanese engineer. And there's no need for China to invade Taiwan because it's also very, again, I'm not a geopolitical expert, neither an expert in military action, but from what I read, it's very difficult for anyone to invade Taiwan given the geography of the island. So, once again, if we come back to this story, I would think that there are still a lot of people among NATO members and even, unfortunately, some people in the US looking to spread wars everywhere. And so I guess that the Korean Peninsula could be a point of tension in the next few months.
Hmm. And kind of segueing to financial markets more so, if you had to be all in on one asset class for the next 5 years or so, what would that be, and why?
Well, I mean, one asset class is difficult. I would rather be in two. So if that would be the case, in fact, and this is not an investment recommendation again, but I would own only physical gold and stocks from the Dow Jones index. Meaning that in the next 3 to 5 years, I see, in fact, the inflationary environment to get even worse. And even at some point, since we have a sovereign debt crisis, first in Europe and possibly elsewhere over this period of time, the asset that you want to avoid is bonds. And since we are going to be in an inflationary environment, you want to own gold, physical gold. I still think that everyone should own between 30 to 40% of his portfolio in physical gold and silver and platinum. And today, the sad reality is that almost every investor still own more than 40% of their portfolio in bonds, which are very, in fact, very risky in the kind of environment we are moving into. And then if I come back to the Dow Jones, why the Dow Jones is because these are the stock, the companies that will go well, will do well across this environment. I mean, these are kind of the blue chip that have historically, I would say, gone through all these difficult economic cycles.
I see. And how about a macro trend or a market signal you think most people are ignoring?
Well, I think that the macro trend that people are ignoring, especially the financial media, is the outperformance of physical gold against equities and let's say against the S&P 500. I think that in 2024, in fact, physical gold outperformed the S&P 500. We are in the same environment year to date. And we start to see, in fact, also other commodities outperforming. Among the best asset class year to date is the Bloomberg Commodity Index. Nobody is talking about this. It's not only precious metal, it's also industrial metals. So you start to see these industrial metals, even if the economy in China is not doing particularly well, even if the economy almost everywhere is not doing particularly well. In fact, you can see industrial metals doing quite reasonably well. And this is because, again, supply has been constrained for many years. And if we are heading in a time of structurally high inflation, as well as a world which is increasingly polarized, in fact, is going to be even much more difficult to get access to any kind of commodities like copper, nickel, uh, even iron ore at some point. So I think that this is under the radar of many investors that, in fact, investing part of their portfolio in these industrial commodities and even at some point soft commodities is a must-have if they want to navigate the stormy waters ahead.
I see. And you mentioned about physical gold, outperforming Bitcoin. Can you can you dive into that one real quick?
Yeah, so I mean, again, I mean, it's quite easy. In fact, I developed an indicator which show that the Bitcoin to gold ratio is usually peaking at the same time of the Nasdaq, and it was again the case in early 2025. So, and you saw the same trend in end of 21, early 2022. So there's no surprise here. Also, I mean, big people miss the point is that Bitcoin needs a lot of energy. So if you believe that the price of energy or the price of real assets are coming up, in fact, this is not a good news for Bitcoin, and this is a good news for gold. Again, I'm not very convinced of Bitcoin as a store of value. To be honest, Bitcoin is more a speculative tool rather than a store of value. So if we are entering into a world where the return of capital is much more important than the return on capital, gold has a long way to outperform Bitcoin.
I see. And then as it relates to, I'm circling back to another point that you made as it relates to a volcanic climate lockdown being enforced. How about that one?
Well, so I mean, as I said, I look at cycles, and it's not only a business cycle. There's a climate cycle. So, in fact, we entered solar minimum at the end of 2024, and historically, when the planet Earth is in a solar minimum, in fact, this is the start of a volcanic cycle. So, meaning that we have already started to see eruption in Italy, and even in Alaska. There's a volcano which has started its eruption again. So it's under the radar of many, many people. Nobody is looking at this, but this is kind of the type of cycle that will also impact uh, the supply of commodities, and will also impact the price of commodities over the next 1 to 3 years. I'm not sure that the volcanic lockdown will take place in 2025. I hope I'm wrong on that one. But to be honest, I think there are increasing risks of this volcanic cycle to happen. If it's not in 25, it could be in 26 or 27, because the peak of the solar minimum will be around the end of 26. So, I mean, it's just a rough indication. I'm looking to do some work for my readers about all the solar cycle impact commodity prices. It's quite a big work, because there's not a lot of data available on that.
I see. Yeah, obviously with the predictions that you're making, and and what you're doing on Substack and stuff, how do you go about? And I asked my previous guest, how do you go about deciphering what information to consume, or where are you going to acquire your information? I guess in short.
Well, I think that there are a lot of noise everywhere. I tend to believe more in market data than in information, or in terms of to base my investment recommendation. So I look at ratio, because I think ratios are giving kind of a good way to analyze the world. And I'm a big believer, as you may have understood, in cycles. And I think that, I mean, maybe because I moved to Asia, where people are quite used of these cycles in life and cycles in everything. So I look at this ratio. I would think that uh, listeners can look at this ratio, like, as I said, the S&P to oil ratio, S&P to gold ratio, gold to bond ratio, and gold to Bitcoin to gold ratio. That this ratio usually give a good indicator of what's going on. I'm not really in terms of trading. I'm more in terms of getting things right, and positioning portfolio for sustainable performance.
And as it relates to obviously speculation, I feel like so many of the shows, whether it's on YouTube or podcasts, everyone is talking about, oh, this crash is going to happen, or this or that. How do you foresee something of that nature unfolding whenever it does? Obviously, no one has a crystal ball, but how do you see that unfolding?
Well, I think I mean, in the short term, what matters is liquidity and capital flows. So I monitor some liquidity indicator, aggregating some data from the Fed. I mean, this liquidity indicator have been tightening, in fact, over the past few months. So they were kind of giving a signal that performance in financial markets will be much lower than what we saw in 2024. Uh, I'm not really in the kind of people who are forecasting a big crash in the stock market and so on. As I said, I mean, investors need to be invested. At the end of the day, if we stay in an environment where inflation is much stickier than everyone expect, it's still better to own a share of Caterpillar or McDonald's or Walmart rather than to own a 30-year government bonds from the US or from France. So you will see probably in the next few months and probably starting the second quarter of this year, some rotation from the bond market into the equity market. The amount that I invested in the bond markets are much bigger than the amount that I invested in the equity market or even in the physical gold market. So this will push prices higher, and this will be the catalyst. So people, in fact, would be confused because they will see negative economic headlines across their financial media, and then they will see probably the Dow Jones climbing, regaining its all-time high or making new all-time high later this year. I think it's still in the card, and this will confuse a lot of people. It's just that, as I said, especially if you are in Europe, you cannot really trust uh, the government anymore. If there is a conflict, clearly, historically, wars have been negative for the performance of bonds and government bonds in particular. So this will push investor to shift from this from the bonds into the equity, and the Dow Jones should benefit from this, and the US equity market should benefit from this against the rest of the world. I start to see a lot of financial commentators telling the world that this is the end of US exceptionalism. I mean, you cannot judge something on 3 weeks performance or 2 months performance. I mean, you have to look for a longer term time horizon, and I still think that uh, the US is still the less dirty shirt in the laundry basket at the end of the day.
What are apart from the U.S., what are some other countries to kind of keep an eye on that's kind of may follow suit, if you will?
Well, I think that for investors that want to take a longer time horizon, Indonesia is a country to keep an eye on. The country is as one of the best demographic profile in the world, much better than China and on par with India. The country is rich in natural resources, so clearly, the country is well positioned for what's coming next. The country has been attracting a foreign direct investor over the past few years from the Western countries as well as from China. So the Indonesia has a sizable economy, a good demographic, uh, good supply, a good profile in terms of commodity supply, and the new president is kind of implementing policies that can be related of make Indonesia great. It's completely under the radar of any Western investor, and I think that it is worth to look at this country if investor want to take a 3 to 5 year time horizon. India is also, I would say, on this time horizon a good pick in terms of investment, because India is already the largest country in the world in terms of population and still have the best demographic. And since India is now able to buy oil in rupee from Russia, in fact, the dynamic of the economy is not really impacted anymore by the weakening currency and by the rising oil price. In terms of sectors to look at, as I said, I think investors' portfolio are clearly underweight in real asset, meaning commodities. And here I include not only the precious metal, but also all the metals that are needed to grow the economy. meaning copper, nickel, and at some point also soft commodities will need to be included in this real asset. And they can also look at all the companies that are related from far or near to this commodity thematic. So, I mean, I just here give some names, but these are not investment recommendation. The kind of Deere, Cortiva, uh, Caterpillar, and so on. So these kind of companies that will benefit from the upcoming next commodity boom, I would say.
Gotcha. And is there something in particular that you feel doesn't receive as much attention as it should? And if so, what might that be?
Well, as I said, I think that unfortunately the financial media are paying too much attention of the Magnificent Seven or the AI, or I mean, this has been the topic of every financial media over the past almost 3 years now, 2.5 years, and nobody is paying attention of what's happening in the commodity space or what's happening in the global south. I think that it's important for people to understand that, as I just said, countries of the global south, meaning China, Russia, India, Indonesia, and other countries in Asia or even in Africa or Latin America, are trading more and more between each other, and are developing a trade relationship outside the old uh, trade business model, which was manufacturing in emerging market and selling in Western countries. I mean, this is kind of a past story. What's coming up is the development of a domestic consumption in emerging market that will take over slowly the US consumption thematic. And again, what's coming up is that these countries are able to trade between each other. And in fact, what I feel personally being here in Asia is that Asian are kind of very pragmatic, and they are mercantilist in a way that they have been traders for centuries. They have been moving goods and selling goods to other countries for centuries, and so they don't really want to mix up of domestic politics when they trade between each other. Meaning that if I take the example, uh, if China sell EVs to Thailand and Thailand sell rice to China, Thailand and China are not going to discuss what's going on in terms of domestic politics. They don't want to interfere domestically, and this is kind of the different situation that this new world is compared to the previous world, where, I mean, unfortunately there was kind of a US imperialism, meaning that to sell goods in the US, you also had to have your political system domestically fit with what the US think is right or not right. This is not the case in Asia. In Asia, people are very pragmatic, and they are looking to make money without, I would say, digging their nose in domestic politics.
I see.
So
Well, Laurent,
if I may add, I think that we
yeah,
will see less and less intervention uh, in the future, because in the new world, which is dominated by the global south, in fact, countries don't want to intervene domestically in the business of its trade partner. And I think that this is the big change that the world is going into versus the post World War II world, where, I mean, the US and even Europe were kind of imposing their way of life or their way of thinking to the rest of the world.
I appreciate you sharing that. Laurent, thanks so much for being on the show. How can people get in touch with you and learn more about you and so on and so forth?
Well, I write a newsletter on Substack, the Macro Butler, so they can reach me there. Then I advise high net worth individuals, so anyone who is interested can also contact me at info@themacrobutler.com.
Well, Laurent, thanks for being on and looking forward to having you on down the road.
Thank you very much and looking forward to our next discussion, Christian.
Yeah, absolutely.